The ProShares Ultra Bloomberg Crude Oil (UCO) is an exchange-traded fund (ETF) that aims to provide investors with leveraged exposure to the price movements of crude oil. The ETF seeks to track the performance of the Bloomberg WTI crude oil subindex, which is designed to reflect the returns that are potentially available through an unleveraged investment in the West Texas Intermediate (WTI) crude oil futures contract. UCO is a 2x leveraged ETF, meaning that it aims to provide twice the daily return of the benchmark index. This can be both an advantage and a disadvantage for investors, as it amplifies potential gains but also increases the potential for losses. It is important to note that leveraged ETFs are not suitable for all investors and should only be used by those who understand the risks and are willing to assume the potential for significant losses. One of the main advantages of investing in UCO is that it allows investors to gain exposure to the crude oil market without having to physically purchase and store the commodity. This can be especially useful for investors who are looking for a way to hedge against inflation or to gain exposure to a specific sector of the market. Additionally, UCO is a liquid investment that can be bought and sold on a stock exchange, which makes it easy for investors to enter and exit their positions. However, it's important to be aware of the risks associated with UCO. Because it is leveraged, the ETF is subject to the risk of compounding, which can cause the value of the investment to decline more quickly than an unleveraged investment. Additionally, the ETF's value may be affected by changes in interest rates, currency exchange rates and other factors. Another important thing to consider is the fact that UCO is an ETF that tracks the performance of a futures contract, which means that it can be impacted by the roll yield. The roll yield is the difference between the spot price of crude oil and the price of the futures contract that the ETF holds. When the spot price of crude oil is higher than the price of the futures contract, the ETF must sell the futures contract at a loss and purchase a new one at a higher price, resulting in a negative roll yield. In addition, it's worth mentioning that UCO is an ETF that provides leveraged exposure to crude oil, which is a highly volatile commodity. The prices of crude oil can be affected by a variety of factors, including geopolitical events, supply and demand, and natural disasters. This means that the value of UCO can fluctuate widely and investors should be prepared for significant losses if the price of crude oil falls. Overall, the ProShares Ultra Bloomberg Crude Oil (UCO) can be a useful tool for investors who are looking for a way to gain leveraged exposure to the crude oil market. However, it's important to be aware of the risks associated with leveraged ETFs and the factors that can affect the value of UCO. As always, investors should conduct their own research and consult with a financial advisor before making any investment decisions.